Understanding support and resistance, the foundation of price action. What if I told you that stock prices have invisible barriers they bounce off like a basketball on a court? These barriers are called support and resistance, and they're the closest thing to magic you'll find in trading. Today we're breaking down the foundation of all price action, support, and resistance levels. Master this concept and you'll start seeing opportunities that most traders completely miss. Think of support and resistance like the floor and the ceiling of a room. Support is a price level where buying pressure typically overcomes selling pressure. It's the floor that catches the falling prices. Here's a perfect example. Imagine a stock hitting a round number like $50 3 different times and bouncing higher each time. That's support in action. Traders see this level and think, this stock at $50 is a good deal, creating natural buying pressure. Now look at the next round number above, let's say $60. Every time our stock approaches this level, it gets pushed back down. That's resistance. Traders think, this stock at $60 is expensive, so they sell, creating selling pressure. These levels aren't random. They form because humans have psychological attachments to round numbers, previous highs and lows, and price levels where big moves started or ended. Here's what makes this powerful. When resistance finally breaks, it often becomes a new support. It's like breaking through the ceiling of one floor to reach the next level. Remember, these levels work because they show you where other traders are likely to buy or sell. You're not predicting the future, you're reading crowd psychology. Identifying these levels is easier than you think. Start by looking for prices where the stock has reversed direction multiple times. The more times it bounces, the stronger the level. Look for these 3 types of levels. Psychological levels like round numbers, $50, $100, $200, previous highs and lows from weeks or months ago, and trend lines that connect multiple swing points. Here's my simple method. Draw horizontal lines at obvious price levels where you see multiple bounces. Don't overthink it. If it's obvious to you, it's obvious to other traders too. The time frame matters. Daily charts show levels for swing traders. Hourly charts work for day traders, and weekly charts help long-term investors. But the strongest levels appear on multiple time frames. Pro tip, look for volume spikes at these levels. High volume confirms that other traders are paying attention. Low volume bounces are less reliable. Remember, the best support and resistance levels are the ones that jump out at you immediately. If you have to squint to see it, it's probably not that important. Now let's put this to work. Day traders love buying near support with tight stops just below the level. If support holds, quick profits. If it breaks, small losses. Swing traders use wider stops, but the same principle. Buy near support, sell near resistance. The longer time frame gives more room for price to work in your favor. Long-term investors use weekly or monthly support levels to support their entries. They're not day trading, but they still want better prices for long-term positions. Regardless of your style, always use stops. Place them just beyond the support or resistance levels you're trading. This gives you clear risk management rules. Support and resistance levels are your roadmap to where other traders are making decisions. Find the obvious levels, trade with proper stops, and adapt to your time frame. Master this foundation and you'll start seeing the market like a professional trader. Ready to build on this knowledge? Well, visit verifiedinvesting.com for advanced strategies and tools.